Now for the latest in a tit-for-tat battle between the world's two largest economies. China has raised tariffs on U.S. goods to 125%. Chinese regime leader Xi Jinping made the first public comment on the escalating trade war, saying in a statement today that China is quote, not afraid. Beijing said the new import rules will be enforced beginning tomorrow. China has indicated it does not intend to go higher than 125%, saying it would be meaningless to engage in further escalation. It comes after President Trump raised tariffs on China to 145%. U.S. Treasury Secretary Scott Bessent previously criticized China for its retaliatory tariffs, saying it would ultimately hurt China more. He noted that China's exports to the United States are 5 times greater than the U.S. exports to China. On Wednesday, Trump paused his latest round of tariffs for 90 days for all countries except China. White House officials say the president is waiting for Beijing to break the impasse, but Beijing has repeatedly refused to arrange a leader-level phone call. Xi Jinping has instead launched a week of high-stakes diplomacy with other trade partners. And corporate filings show the new CEO of Intel has invested in hundreds of Chinese tech firms, including at least 8 with links to the Chinese military. Lip Bu Tan became CEO of the U.S.'s largest chip maker last month. The findings have raised questions among some investors and complicates the issues of Intel's efforts to revive its business. Intel manufactures cutting-edge chips for the U.S. Department of Defense. Intel is also the only U.S.-based company making the most advanced computer chips in the world. But Tan controls more than 40 Chinese companies and funds, as well as having minority stakes in over 600 via investment firms he manages or owns. In many instances, he shares minority stake ownership with Chinese regime entities. Intel declined to comment on the matter. A spokesperson said Tan completed a questionnaire that requires disclosure of potential conflicts of interest. Next, Tesla has stopped taking orders for 2 imported US-made models on its Chinese website. They are Model S and Model X, but the Model 3 and Model Y are still listed. A key difference is those vehicles are made at Tesla's Gigafactory in Shanghai. They are much more popular in China, which is the world's largest car market. The S and X are mostly produced in the US and have always been niche vehicles in the Chinese market. Neither Tesla nor CEO Elon Musk must have commented on the matter. But it comes as China imposed new retaliatory tariffs on 125% on US imports. US tariffs on all Chinese goods have climbed to 145%. Investors hoping for an end to market swings are still waiting to see what comes next. The impact to earnings, the economy, and equities are still being watched.
Donald Trump's move to postpone most of his new tariffs for 90 days seems to have brought only fleeting relief for markets. After a huge rally Thursday, Friday saw Asian stocks head lower again. Japan's Nikkei index closed down about 3%, while South Korea's benchmark Kospi index dropped about 0.5%. Markets in China fared better, however, with Hong Kong's Hang Seng index reversing early losses to gain 1% by mid-afternoon. That came amid reports of state funds stepping in to buy equities. The night before, Trump had indicated that he was open to negotiation.
What happens with China? We would love to be able to work a deal.
US Treasury Secretary Scott Bessent also tried to offer hope, saying over 75 countries wanted to start talks. On Friday, the US and Vietnam agreed to begin formal negotiations. Meanwhile, media reports said Japanese Prime Minister Shigeru Ishiba hoped to send a trade task force to Washington next week. But with Trump's total duties on China now at 145%, investors remain anxious that a global economic slowdown is coming. Investec economist Ellie Henderson says markets also remain concerned by the volatility of Washington policymaking.
We would far from say that uncertainty is over. We may have a brief pause for now with this 90-day pause on reciprocal tariffs, but it's still not clear what the end game is for Mr. Trump in terms of tariffs and how countries will negotiate. I think uncertainty is definitely here to stay, at least for the time being.
Such worries saw money flow into traditional safe havens, with the Swiss franc hitting 10-year highs against the dollar on Friday. Gold also saw gains. But US government bonds, normally also a safe haven, sold off again. That has raised concerns of deeper trouble in the financial system, with asset managers possibly forced to sell bonds to cover losses elsewhere.
U.S. port operators and shippers are calling on President Trump to back off on proposed port fees on Chinese vessels. His proposed plan to impose port fees of up to $3.5 million on China-linked commercial carriers could take effect as soon as April 17th. Under the proposal, ships operated by Chinese companies would be charged $1 million, while ships built in China would pay $1.5 million per port call. The proposal was heavily criticized by shipping and ports representatives. U.S. shippers say the fees would disproportionately harm American-owned carriers. U.S. Trade Representative Jamieson Greer said earlier this week that not all port fees would be implemented. Gold prices breached the $3,200 level for the first time in history today. The move was fueled by a weaker dollar and an escalating trade war that sent investors rushing towards safe haven assets like gold. Bullion rose more than 1% to scale an all-time peak of almost $3,220 per ounce earlier in the session. It has gained around 5% this week. The dollar was down around 1% versus major peers today, which made it cheaper for overseas buyers to buy greenback priced bullion. Tariffs have been a major driver of gold's appeal, but central bank demand, expectations of interest rate cuts by the Federal Reserve, and geopolitical instability has also fueled the metal's rally this year. Joining me now to discuss tariffs, markets, and the economy is Sam Burns, Chief Strategist at Mill Street Research. Sam, it's great to have you.
Thank you for having me.
Now, China is retaliating against President Trump's tariffs. It's raising its rate on U.S. imports by 41 points to 125%, while the U.S. rate is, of course, 145%. What does this escalation mean for global markets?
Well, I think it's clearly gotten to the point where tariffs this high are effectively almost a complete disruption or ending of trade between China and the U.S. Almost no business can possibly pay tariffs, of over 100%. So at this point, no matter how much higher they might go, it effectively means that companies won't be able to ship goods back and forth. Importers and exporters will be virtually cut off from trading between the U.S. and China, which of course will have a lot of implications for many industries in the U.S. who rely on imported goods either directly or indirectly.
Now, you've been watching this up and down of the markets. We saw a historic drop in the market. We saw a historic gain in the markets just ever since April 2nd, when Trump made these reciprocal tariff announcements. How is that playing out? I mean, how do you see that volatility playing out in the next few weeks? Are things going to level out, or?
No, I think the volatility is likely to continue. Historically, when you get moves like this, they rarely suddenly just stop all of a sudden and go back to being kind of placid markets. I think you're going to be in for at least another few weeks or months of high volatility. You're going to get big sell-offs and big rallies. The market is extremely sensitive to every headline that comes across regarding tariffs or other macroeconomic policies or the Federal Reserve. Today, I think there was some news that suggested the Fed would step in if markets got really out of line. They're not, and so the Fed will probably not step in anytime soon. But it was enough to cause investors to want to at least maybe cover some shorts and buy. So I think there's a lot of volatility that's going to continue. In part because traders are so kind of confused, And because the underlying driver of all this, the Trump tariffs, are still there and don't seem to be going anywhere anytime soon. So as long as that uncertainty is this high, I think it's going to be very difficult for the market to settle down.
Now, look, we're talking about the markets, we're talking about Wall Street. Obviously, volatility there is just driving traders crazy. I'm sure people like yourself are having a whirlwind of the past couple of days, weeks. But what does all this mean for the American consumer? What does it mean for Main Street?
I think for the average consumer, what they're going to be seeing pretty soon is higher prices at the grocery store and the stores. And I think in some cases, and maybe even in a few weeks, there'll be things that they used to be able to buy easily, whether it's from Amazon or online or within a store, that which simply won't be there anymore. They won't be shipped because the producers, the importers, and things like that won't be able to source them or to pay for them. And then they'll also, of course, they might see their 401k in their retirement portfolios being volatile and coming down, which is going to be a worry. So you might have a little bit of effect on that. But autos in particular are going to be impacted heavily. And anything that goes through goes through China is going to be impacted heavily. So I think you're going to start to see that show up in stores, things you buy, and as well as in your investment portfolios.
Now, yeah, I mean, these tariffs are going to bring some significant changes for consumers, for Wall Street, for traders, and so on. But these tariffs aren't only about the economy. I mean, there's a certain principle. Trump talks about fair trade and ensuring that the U.S. is treated fairly. Is that sentiment shared amongst your peers?
I would say no, in the sense that none of the economists or strategists, other people that I would consider peers, would think that anything like this would be the way to deal with concerns about trade between the U.S. and other countries. Generally speaking, most economists view tariffs as a very poor way to address trade disputes or trade imbalances, that there are better ways to deal with them. And normally new trade treaties and trade negotiations go on for many months and sometimes years to work out very specific arrangements around specific products and specific countries. Anything that's like this that is across the board, or almost every country and every product, even things that we don't make in the U.S. and can't make in the U.S., or agricultural products that we can't grow here. The fact that these things are so comprehensive and so astronomically large compared to where tariffs and other things have been historically in the last 10, 20, 30 years means that they're far, far out of proportion of any kind of normal kind of trade concerns or whether the U.S. is being treated fairly. I think the U.S. has generally benefited a lot from the trade that it's been doing over the last several decades in many ways, and so disrupting it will be a big net negative for the U.S. Either way, and the uncertainty that comes with it will certainly be.
Okay, Sam, I want to get your take on this. Chinese regime leader Xi Jinping is calling on the EU, the European Union, to unify with China against Trump's tariffs. What incentive does the EU have to side with China over the U.S. in this instant?
Well, yeah, I don't think the EU has a lot of incentive to align with China, broadly speaking. But I think everyone is now looking for ways to, reduce their exposure to the U.S. or to find other ways to get the goods that they need without having to go through U.S. and pay these tariffs and other things. So I think everyone, the EU included, is looking for alternatives, and China is, I think, trying to kind of offer some alternatives for ways to deal more directly with the EU and to try to put pressure on Trump and the administration to scale back these tariffs. I think the pressure is going to come both from outside the U.S., the EU, and China, and a lot of other countries, as well as from inside. Pretty soon, I think a lot of U.S. businesses, and then eventually the U.S. Congress will start to feel the pressure from their constituents to kind of do something about this, because I think it's going to become pretty painful pretty quickly, both within and outside the U.S.
Sam, in closing here, what is your advice to the average American trying to save for retirement with all this volatility in the market? I mean, these are people who just want to retire comfortably in maybe the next 10, 20, 30, 40 years.
Well, I think the important thing for most individual savers is to keep saving, meaning put aside some percentage of your income and keep make sure you keep doing that. It might be sensible to kind of hold some more of it in say cash or bonds, things that are safer, and not stocks for a little while, just because to let yourselves kind of sleep at night, so you're not worried about the volatility of your portfolio as much. But I think the key thing is to keep saving, keep investing over the long run, particularly if you have many years before you expect to retire. If you're very close to retirement, you might want to scale back a little bit, own more cash and fixed income kind of investments. If you think that this kind of situation with the policy is going to go on for a number of months or even years, under the Trump administration may have another 3.5 years to go. So I think there's some risk there for the longer term growth prospects of the U.S. if things don't change soon. But I think overall the key thing is to kind of try to stick with your plan and maybe just scale back your risk profile a little bit.
All right, Sam Burns, Mill Street Research. Thank you.
My pleasure. Thank you.
Next, the European Union and China have agreed to look into setting minimum prices for Chinese-made electric vehicles instead of tariffs imposed by the EU last year. A European Commission spokesperson said yesterday that the EU Trade Commissioner spoke with China's Commerce Minister. Both sides agreed to look into setting minimum prices. The spokesperson said China's ministry said in a statement that negotiations were set to start immediately. Previous minimum price deals agreed to by the EU have been for simple commodities rather than complex products such as cars. The EU increased tariffs on Chinese-built EVs to as much as 45% last October. The EU spokesperson added that the next meeting between European and Chinese officials is expected to be held in Beijing in July. According to the Internal Revenue Service, people unable to file their 2024 tax returns by tax day next Tuesday should consider requesting an extension. The IRS also said that there is still time to file federal income tax returns electronically and request direct deposit of any refund. If you need an extension, the IRS said you can request one through IRS Free File by filing a Form 4868 and sending it in electronically or by mail by April 15th. The IRS notes that even when a request is granted, it does not give the taxpayer the right to postpone paying their taxes. If taxes due on April 15th are not paid on time, interest will start accruing on the unpaid balance at the rate of 7% per year, compounded daily. More than $179 billion in tax refunds have been issued by the agency so far this year, up almost 6% from last year. Next, U.S. wholesale prices fell last month. It's an indication of a strong economy before the bulk of U.S. trade policies kicked in. In Labor Department data released Friday, the Producer Price Index showed that prices paid to producers fell 0.4% in March from the month before and slowed on an annual basis to 2.7%. The PPI is a closely watched measure of wholesale inflation. It serves as a potential bellwether for retail-level inflation in the months ahead. This index also is being scrutinized to gain insight as to the initial impacts of President Trump's sweeping new and proposed tariffs. The Chinese Semiconductor Association says U.S. chip makers that outsourcing manufacturing will be exempt from China's retaliatory tariffs. Given the highly specialized and multi-country nature of chip supply chains, there was uncertainty within the industry about how tariffs would be applied to chip imports. According to chipmaker platform EETop, for U.S. chip designers like Qualcomm and AMD that outsource manufacturing to Taiwanese chipmaker TSMC, Chinese customs authorities will classify these chips' place of origin as Taiwan, and Chinese tariffs won't apply. The high tariff rate will still apply for chips made in the U.S. The chief investment officer at Running Point Capital said China's exemption for outsourced U.S. chip makers appears to be a calculated move to maintain economic stability and encourage foreign investment in local manufacturing. Bernstein analysts said the move was a big surprise to the markets as investors generally considered the location of packaging to be the country of origin not the location of fabrication, and it's much more difficult to shift fabrication. JP Morgan CEO Jamie Dimon addressed what he described as considerable turbulence facing the economy. This is despite his firm posting quarterly earnings that beat Wall Street estimates. Dimon said the global trade war is adding to an uncertain economic environment that the world's largest bank will continue to navigate for the foreseeable future. Despite surging revenue from JP Morgan's markets and investment banking businesses, Dimon said recent turmoil threatens those units. He also said inflation remains sticky as parts of the economy like housing have not receded from the price hikes in recent years. The US dollar fell to the weakest level against the euro in 3 years this morning. The greenback weakened nearly 2% by 5 a.m. Eastern Time to hit $1.14 against the euro. That's the dollar's weakest value against the euro since February 2022. The US dollar index, which measures the dollar's value against other major currencies, had also weakened 1.3% by the same time. GNC, a national supplement retailer, is actually a Chinese-owned company, and a number of GNC stores are located on U.S. military bases. A bill is being introduced in Congress that would remove those stores. 3 senators and 1 congressman are calling it a matter of national security. NTD's Sean Marshall has more.
Some may not know that GNC, the popular supplement retail chain, is owned by a Chinese company. Ultimately, under the control of the Chinese Communist Party, the company operates over 80 stores on American military bases. Senators Tom Cotton, Rick Scott, and Ted Budd are introducing a bill that would ban GNC and other stores controlled by China and other hostile regimes from operating on U.S. military bases. Congressman Pat Harrigan introduced companion legislation in the House of Representatives.
Let me be clear. A foreign adversary has a physical, ongoing presence on our military installations.
They're expressing concern that GNC operates with almost no oversight, has access to data on military personnel, and answers directly to a hostile foreign regime.
This is not just about names and addresses. It's about behaviors, patterns, and vulnerabilities. The Chinese government has the tools they need to build detailed, individualized profiles on our troops, tracking habits, routines, deployment cycles, and even psychological flags. Everything a hostile intelligence service needs to start shaping a target.
GNC used to be American-owned and was founded in 1935. It grew from a single store in Pittsburgh into a national chain until filing for bankruptcy in 2020. At that point, it was acquired by China's state-run Harbin Pharmaceutical Group.
That's why I've introduced the Military Installation Retail Security Act of 2025. This bill prohibits the military exchanges from allowing any company owned or controlled by the governments of China, Russia, Iran, or North Korea from being able to operate a physical location on our military installations. It terminates existing contracts with companies that lied about who they really are. And it slams shut the legal loopholes that allowed this threat to take root in the first place.
GNC currently operates through long-term contracts with several military exchanges. Senator Ted Budd's website states that at North Carolina's Fort Bragg, GNC operates several storefronts serving almost 54,000 troops who make up nearly 10% of the U.S. Army alone. Sean Marshall, NTD News.